Well, the resilient consumer might be slowing down. Out today, retail sales declining more than expected in January. To break down what risks may lie ahead for the market, we have Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Thank you for joining us this morning. So how much should we read into this print?
We've been saying for some time that the consumer is going to hit a wall, especially after the holidays. I mean, when you look at what's going on with the labor market, which is starting to cool, when you look at the fact that interest rates, although they didn't have an impact right away, anytime somebody goes to refinance a mortgage or buy a new home or take out a new credit card or a new auto loan, they're paying a much, much higher rate than they did a few years ago. And so we think that that's going to continue to slow the economy, and that's probably going to put some downward pressure on the consumer, which thus far has been very resilient.
And we've been focused in on, of course, a lot of the different readings on the consumer. Earlier this week, it was CPI. Of course, here today, retail sales. Where for investors is really the better gauge of still this consumer and the resiliency, but also now the question of that resiliency as put on by the retail sales figure?
Yeah, I mean, look, the consumer is going to spend as long as they have a job, right? As long as they have a job, as long as they can access income, they're probably going to spend. I mean, that's just how it always works historically, right? They're some of the last folks to kind of figure out that there's a impending slowdown. So I think what you need to do is look at those leading economic indicators. I think what you need to do is acknowledge how much higher interest rates are. I think you need to acknowledge how much kind of higher the costs most of us are spending just to kind of keep our households going. And I think from that standpoint, I think you can see that once the labor market weakens significantly, which it should as the year goes on, you can see that in some of the layoff announcements and some of the other areas that we look at. That's going to eventually catch up to the consumer, and they're probably going to get hit probably the second half of this year.
So, Samir, obviously a wave of economic data coming out this week. Would you say there are three particular when it comes to economic growth risks that markets are still underpricing at the moment?
Yeah, I mean, look, the first one is inflation, right? I mean, the tricky part is you're still seeing companies have quite a bit of pricing power, although it's less than it was. You're still seeing wages be quite a bit sticky. Unfortunately, that has a lot to do with the fact that there's still a shortage of labor. And then honestly, I think it's just, the lag this time around because of those interest rates, because everybody refinanced in 2020, 2021. I think that lag is a little bit longer this time. But, honestly, history tells you it's about 2 years from when the Fed first starts hiking rates, when the economy slows, and we're right on schedule. And I think later this year, I think those rate impacts will really show up.
Okay, and so as we're continuing to really evaluate where the investors who are evaluating this data are trying to position their portfolios, what is the hot positioning that they should be considering if the Fed pushes out its rate cutting?
Yeah, so we would still play defense at the portfolio level. That means, underweighting equities and favoring fixed income, and we like commodities. They tend to do well, especially when inflation surprises to the upside, where we're not quite, giving up on inflation as maybe others are. At the sector level, we like industrials, materials, energy, and healthcare. Those are sectors with great, cheap valuations, companies that have just as much profitability as some of the tech and tech plus areas. But again, the valuations are much more reasonable, which will hold up in a higher rate environment. We would avoid consumer discretionary, real estate, and financials, mostly for obvious reasons. But again, we think the consumer hits a wall, and we think, real estate, especially commercial real estate, continues to be a problem that tends to impact REITs. And then for financials, I mean, look, it's just going to be very difficult to make money if you don't have a steep curve.
And for those who are wondering if it's too late for them to get defensive, especially given the moves that we continue to see in yields on some of these defensive sectors, have they missed the boat there, or is there still room to get in?
I mean, look, with the market at all-time highs, there's probably never been a better time for you to get more defensive, right? Because probably the areas that you're trimming, especially right now, those tech and tech plus areas, again, they have done so well. You just mentioned semiconductors and how well they've done. Not to take anything away from the longer-term earnings power, but again, they've really overshot, and those are the areas we want folks to probably trim most.
All right, Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Thank you so much for taking the time here this morning. Appreciate it.